Today's topic of discussion is the financial markets. So, we'll know more about the financial markets in India. Financial markets in India are classified as money market, capital market, and government securities market. Let us know in detail one by one. Money market is nothing but a correlation for short-term funds with maturity ranging from overnight to 1 year, including financial instruments that are deemed to be close substitutes of money. It means money market is a place where the short-term financial instruments having a maturity period of less than 1 year are dealt along with the close substitutes of money. Indian money market consists of diverse submarkets, each dealing in particular type of short-term credit. It is highly liquid market which provides you fixed returns. Money market fulfills the borrowing and investment requirements of providers and it balances the demand for and supply of short-term funds by providing an equilibrium mechanism. It serves as a focal point for the central bank's intervention in the market. Next, we'll know more about the instruments of money market. So these are treasury bills or cash management bills, call money, notice money or term money, that is different types of money, commercial papers, certificate of deposits, repurchase agreements, forward rate agreements and interest rate swaps. Treasury bills or T-bills are nothing but money market instruments which are short-term debt instruments also known as government bonds or debt securities having a maturity of less than a year issued by the Government of India, so these are also known as government securities. These are offered with the maturities of different time periods, that is, the duration ranges from 28 days, 91 days, 182 days, and 364 days in a year. Treasury bills are zero coupon securities and pay no interest before the expiry of the maturity period. These are sold in auctions at a discount from the par value of the bill, issued to meet short-term mismatches in receipt and expenditure. Bonds of longer maturity are known as dated securities and T-bill is also known as negotiable instrument because it is freely transferable and guarantees the payment of a specific amount of money through demand and after stipulated time period. Next is cash management bill. These are again short-term bills issued by the central government, so it is also a government security as well to meet the immediate cash needs and mismatches in the government running. So cash management bills are used by the government. In India, RBI issues it on behalf of the government to meet the temporary cash flow and its mismatches. Next, we'll know about the types of money. We'll have call money, term money, and notice money. It facilitates lending and borrowing of funds between banks and entities like primary dealers. An institution which has surplus funds may lend them on an uncollateralized basis to an institution which is short of funds. That is, an institution can aid you with different types of money without having any type of collateral or additional security like we have mortgage securities when we take loan. So without it, you can have the cash flow immediately. You can immediately have liquid instruments in your hand. It is used for interbank transactions. When you borrow the money or lend the money for a day, it is known as call money. But when the money is borrowed or lent for a period between 2 to 14 days, it is termed as notice money. And when the term exceeds 14 days, it is termed as term money. Moving ahead, commercial paper. Commercial paper or commercial money instrument was introduced as a background trend of liberalization during 1985 to 1990. It proved as an innovator facilitator in the financial market. It is issued in the form of promissory note and acts as a debt instrument used by the large corporate companies. Earlier, for the companies to have the loan facility, they had to depend on the crude and traditional method of borrowing working capital from the commercial banks by pledging inventory of raw material as collateral security. But with the invent of the commercial paper, it has become more easy to avail short-term funds for day-to-day production activities within the shortest possible time limit by avoiding the hassles of direct negotiation. You can avail the money. The main issues of CP in the market are incorporated manufacturers and subscribers are banking companies. It is issued by the issuers at discount of face value of commercial paper. the denomination of 0.5 million rupees and multiples thereof. The maturity period ranges between minimum of 15 days and maximum of 1 year from the date of issue. The other issuers of CP in the market are primary dealers and all Indian financial institutions, and the other investors or subscribers. Those who can invest in CP or those who can subscribe to the CP are individuals, NRIs, and foreign institutional investors, that is FII. Moving ahead, we have certificate of deposits or CD. It is a time deposit, a financial product commonly sold by banks, thrift institutions, and credit unions. It differs from savings account. It is more like a fixed deposit account where the amount is fixed, that is often 1, 3, or 6 months, or often 5 years, usually with a fixed interest rate. So the bank expects CD to be held until maturity, that is, you will not withdraw. Unlike savings account, you withdraw it beforehand or at any time you need it, at which time they can be withdrawn and interest can be paid. So it is an arrangement between the depositor of money and the bank, issued in dematerialized form. It can be issued by any All India financial institution or scheduled commercial bank. Like a fixed deposit, I have said, a CD's purpose is to denote in writing that you have deposited money in a bank for a fixed period and that bank will pay you interest on it based on the amount and duration of your deposit. Repurchase agreements are the most important instrument of the money market because it involves repo and reverse repo rate dealings. So it is also known as repo, RP or sale and repurchase agreement, a type of short-term borrowing mainly in government securities. It is very important to know that these instruments are held as government securities as well. The dealer sells the underlying security to investors by agreement between two parties, and the parties buy back them shortly afterwards, usually the following day, at a slightly higher price. The repo rate is an important source of funds for large financial institutions in the non-depository banking sector, which has grown to rival the traditional depository banking sector in size. So the large institutional investors such as money market mutual funds lend money to financial institutions such as investment banks either in exchange or for a collateral such as treasury bonds and mortgage-backed securities held by the borrower of financial institutions. Next is forward rate agreements or FRAs. So these are similar to forward contracts where one party agrees to borrow or lend a certain amount of money at a fixed rate on a pre-specified future date. So the amount of money is certain, it is not fixed, but the rate of interest is fixed and the date of borrowing or lending is fixed, that is, it is pre-specified. For example, I will borrow a sum of amount near about of 50,000. The amount can be between 45,000 to 55,000, that is, it will be near about 50,000. I will borrow it from you or you will lend it to me after 60 days. It is pre-specified. For a period of 90 days you will lend me or I will borrow it at the fixed interest rate of 10%. So this is forward rate agreement. A financial contract between two parties to exchange interest payments for a notional principal amount. It is important that the principal amount is notional but the interest is fixed and the time period is fixed. The settlement rate is agreed benchmark or reference rate prevailing on the settlement date. Next is interest rate swaps. Here you exchange interest as the name suggests. So it is a type of derivative contract through which two counterparties agree to exchange one stream of future interest payments for another based on a specified principal amount. Here the principal amount is specified but the interest changes. In most cases, interest rate swaps include the exchange of a fixed interest rate for a floating rate. I may have decided my interest rate to be fixed, but the opposite party might have the floating rate. That is, the party will decide it on the variable basis in future. So here the interest rate changes. Unlike in last slide we have seen, in forward rate agreements, the principal changes. That is, principal is uncertain, and here the interest rate is not certain. Generally, two parties in an interest rate swap are trading a fixed rate and variable interest rate. For example, a company may have a bond that pays LIBOR while the other company holds a bond that has fixed payment of interest. Moving ahead to the capital market. So we have studied in detail the money market instruments. Now we'll move ahead to the capital market. So capital market is also a financial market in which long-term debt or equity-backed securities are bought and sold. Here we bought and sold the securities which are traded are held for more than a year. But in money market, the securities were held for less than a year. In money market, we can have easy access to the liquid instruments. We can have easy availability of our liquidity. We can change easily our assets into cash form. But in capital market, it is a channel. It channels the wealth of savers to those who can put it into long-term productive use, such as companies, government, making them long-term investment. So our savings are channelized into capital investments for long-term productive use. Unlike money market, it was for immediate liquidity, and here it is for long-term investments. So in the primary market, usually company sells to investor, and in the secondary market, investor sells to investors. So primary market and secondary market are the two types of market classified under capital market. Primary market deals with new stock or bond issues which are sold to investors via underwriting. Here the government issues only bonds, whereas companies often issue both equity and bonds. Main entities dealing here are pension funds, hedge funds, sovereign wealth funds, and less commonly wealthy individuals and investment banks trading on their own behalf. Funds borrowed from money markets are typically used for general operating expenses to provide liquid assets, as I said earlier, for brief periods or short duration. Moving ahead to the secondary market, here, existing securities are sold and bought among investors or traders, usually on an exchange or over the counter or elsewhere. It consists of a series of channels through which the savings of the community are made available for industrial and commercial enterprises and public authorities. Our savings are held for industrial, commercial, and public usage. It deals with the exchange of prevailing security or previously issued securities among investors, that is equity, preference shares, debentures and bonds. The purpose here to invest is to invest in additional physical capital goods which will be used to help increase its income. It enhances income. Primary market helps us to have immediate liquidity, whereas secondary market helps us to enhance our income. So in the primary market, securities are issued directly to the investors or through intermediaries, as we have seen in the picture. In the secondary market, ownership of existing securities is exchanged between the investors, but the company is not involved. Ownership is exchanged, but company is not involved here. In the primary market, capital formation happens, and in the secondary market, it indirectly promotes capital formation by providing liquidity. In the primary market, only buying of securities take place, whereas in the secondary market, buying as well as selling takes place. Prices of securities are decided by the company in the primary market, whereas prices are decided by the demand and supply of securities in the secondary market. Primary market has no fixed geographical location, whereas secondary market has specified places. Let us know more about government securities market, that is the third type of financial market in India. The government securities market is at the core of financial markets in the most countries. It deals with tradable debt instruments issued by the government for meeting its financing requirements. These are debt instruments issued by the governments to borrow money. The two main important types here are treasury bills, short-term instruments with maturity of 91 days, 182 days and 364 days. That is first, treasury bills. And second we have is dated securities. These are the long-term instruments. Treasury bill is a short-term instrument. Dated security is a long-term instrument with a maturity ranging from 5 years to 40 years. Primary market consists of the issuers of the securities here. For example, central and state government and buyers include commercial. So central and state government are the issuers of the security. This is the primary market here. But the issuers consist of or the buyers consist of subscribers or buyers consist of commercial banks, primary dealers, financial institutions, insurance companies and cooperative banks. RBI also has a scheme of non-competitive bidding for small investors. Let us see the types of government securities. These are also classified as T-bills, cash management bills, dated government securities or G-SECs, and state development loans, that is SDLs. We have already discussed about treasury bills and cash management bills. So we'll know more about the dated securities here. In India, the central government issues both T-bills as well as dated securities, which are held for long-term period. Dated securities are held for long-term period. Treasury bills are held for short-term duration. So while the state government issues only bonds or dated securities to raise funds from the market at market determined rate using auction mechanism, it is called as state development loans. The minimum amount of issue or sell here is 10,000, whereas G6 carry practically no risk of default and hence are called risk-free or gilt-edged instruments. RBI conducts auctions of G6, that is government-dated securities, with a maturity of a year or more, where institutional investors like banks or any other financial institutions can place competitive bids for them. It is not for common people, and retail investors can apply for allotment. So retail investors like common people can apply for allotment, but competitive bids are placed by the institutional investors. Retail investors can also technically invest in G6 through RBI trading platform. However, awareness is low and liquidity is poor because the market trades in wholesale, that is lots of 5 crore and not in retail loans. So you must have the income of or finance of rupees 5 crore to deal individually as retail investor in G6 security. So it is usually dealt by the institutional investors. So here I have a few questions for you. Question number 1 is, dash refers to borrowing or lending of funds for period exceeding 14 days. Which type of money it is? Next is, G6 carry practically no risk of default and hence are called dash instruments. Hope you enjoyed the video. Do answer these questions in the comment section and stay tuned for more such videos.